Right now, Monday.com, ticker MNDY, is trading live at $163.08, which is a staggering intraday drop of $26.51 or 13.98%. The stock gapped down hard at the open, hitting a new 52-week low of $151 earlier in the session and has been struggling to find its footing ever since. Anyone looking at that bright red number on their Fidelity mobile app or Robinhood platform would immediately assume the company just reported an absolute catastrophe. The expectation when you see a 14% collapse is a massive miss on earnings, a huge miss on revenue, and probably a guidance cut that signals the business is in free fall. That is the expectation. But here is the reality, which is far more complex and, for long-term investors, far more confusing. Monday.com actually beat Wall Street's expectations for its third quarter. Revenue came in at $316.9 million, beating the $312.4 million estimate. Adjusted earnings per share were $1.16, which didn't just beat the 88-cent consensus, it crushed it. The company even reported its highest ever non-GAAP operating profit and a spectacular 28.5% free cash flow margin. By all traditional metrics of a good quarter, this was a success. The stock isn't collapsing because of what it just did. It's collapsing because of what it said about the next 3 months. This is a classic, brutal case of beat and lower, and in this nervous market, forward guidance is the only thing that matters. For the last several years, the general belief surrounding Monday.com was one of unstoppable hypergrowth. It was the colorful, friendly work OS that was taking over offices, a top pick for online investing in the post-pandemic software boom. Investors piled in, using platforms from SoFi Invest to interactive brokers, assuming this was the next great software-as-a-service story. The expectation was that this company, which had posted 50% plus annualized growth in the past, would continue to grow at 30 or 40% indefinitely. It was often spoken of with the same growth expectations as a young Tesla stock or Nvidia stock. But today's 14% haircut forces us to stop and challenge that entire narrative. The reality is that the hypergrowth phase is over. The company's Q3 revenue growth was 26.2% year over year. That's a strong number for a normal company, but it's a significant deceleration for Monday.com. And the guidance for the fourth quarter, the very thing that is sinking the stock, confirms this new reality. Management projected Q4 revenue at $329 million at the midpoint. The street was looking for $333.8 million. It may seem like a small miss, just 1.4% below consensus, but in the world of high-growth SaaS, a guidance miss is a fatal flaw. It breaks the growth story. The market is now being forced live to revalue Monday.com not as a hypergrowth rocket, but as a maturing, profitable, but slower software company. This is a painful transition, and it's why so many automated Schwab Intelligent portfolios and institutional funds are dumping the stock today. Let's look closer at what's happening under the hood of this move. The trading volume is enormous, already at 3.45 million shares, which is several times its daily average. This isn't just a few people doing self-investing getting scared. This is institutional reweighting. This is Fidelity Wealth Management and other large funds with complex valuation models hitting the sell button. Their models, which just yesterday might have price targets of $275 like Piper Sandler or D.A. Davidson, are now broken. Those models were built on an assumption of 25 to 30% forward growth, and the Q4 guidance just signaled that the real growth rate heading into 2026 might be closer to 22.8%. This is the core of the problem. Management on the earnings call tried to focus on the good news, and there was a lot of it. The CFO, Ron Glazier, highlighted the highest ever non-GAAP operating profit and a 28.5% free cash flow margin. This company is not a cash-burning startup. It's a cash flow machine. This is a sign of a very healthy, efficient business. But the market is ignoring the profit and focusing on the growth deceleration. Let's look at the other key metrics. The net revenue retention rate was 115%. This is a solid metric. It means that on average, existing customers from 1 year ago are spending 15% more with Monday.com today. This is how the land and expand model works. It's not a bad number, but it's not the 120 or 125% that gets growth investors really excited. It's in line with the previous quarter, which means it's stable, not accelerating. The other key metric is the number of large customers, those paying over $50,000 per year. That number grew to 3,993. This is actually the bull case. This shows that Monday's strategy of moving up market from small teams to large enterprise-wide contracts is working. This is where the big, sticky investment comes from. The problem is that the Q4 guidance implies that this growth in enterprise is not happening fast enough to offset a slowdown in the small and medium business segment, which is more exposed to macroeconomic pressures. The SaaS market in general is maturing. We're past the growth at all costs phase. Customers are now practicing FinOps, or financial operations, to audit their cloud spending. They're cutting redundant apps. Monday.com now has to fight harder to prove it is an essential platform, not just a nice-to-have tool that overlaps with the free features in Microsoft Teams. The disconnect between a profitable 28.5% cash flow margin quarter and a 14% stock crash is jarring. It tests the conviction of anyone doing self-investing. This is where the real investment help is needed. So let me ask you, comment below what you think is the real long-term growth rate for Monday.com. Is it 20 to 25%, or is this slowdown just a blip? For those who are newer to the story, Monday.com's business is built on what it calls the work operating system. Think of it as a set of highly visual, customizable building blocks. It's famous for its colorful boards that can be adapted for just about anything. Project management, sales pipelines, marketing campaign tracking, bug tracking, and even light CRM. It competes fiercely with rivals like Asana, Smartsheet, and ClickUp. The company makes its revenue through a classic software-as-a-service subscription model. It offers different tiers, Basic, Standard, Pro, and Enterprise, with more features and automations as the price goes up. Their core strategy has always been land and expand. They get a single marketing team or product team to start using the free or cheap plan, often discovered through word of mouth. That team loves it, then the sales team wants in, then HR. Before you know it, the entire company is running on Monday.com, and they sign a massive multi-year enterprise license. This is why that 115% net revenue retention rate and the 3,993 large customer count are so critical. That's the business model in action. This stock has always been a volatile name for anyone holding it in an individual brokerage account. It IPO'd in 2021, went on a spectacular run to over $400, and then, like many high-growth tech stocks, collapsed in the 2022 bear market, falling below $100. The recovery from those lows has been impressive, but it was all built on the assumption that the growth story was intact. Today, that assumption is being called into question. So, where does the stock go from here? This is the new debate, and it creates two very different possible futures for investors. The bull case, the argument for buying this 14% dip on your SoFi trading platform or Interactive Brokers account, is that this is a massive market overreaction. The bulls will point to the fundamentals. This company is wildly profitable. A 28.5% free cash flow margin is elite. This isn't a startup lighting cash on fire. It's a mature business that can fund its own growth. They can use that cash to invest heavily in new products, like their Monday Agents and Monday Sidekick AI features, which could be a huge catalyst for upselling. They can also use that cash for stock buybacks. The bulls will argue that the push into enterprise with nearly 4,000 large customers is the real story, and that this segment is sticky and will offset any short-term SMB weakness. They'll say the 52-week low of $151 was the bottom, and this is a great entry point for a long-term investment. Then there is the bear case, which is the reality that the market is voting for today. The bears say this isn't a blip, it's the new normal. The deceleration is real and permanent. The 22.8% forward growth rate is what this company is now, and it should be valued as such. They will argue that competition is finally putting a ceiling on growth. Microsoft is a powerful enemy, and bundling its own planner and project tools into the Microsoft 365 ecosystem that companies already pay for is a massive headwind. The bears will argue that even after a 14% drop, the stock is still expensive if it's only a 20 to 25% grower. It's not Apple stock, which is a hardware ecosystem fortress, and it's not NVIDIA stock, which has a near monopoly on the chips that power the AI boom. It's a tweener, a company caught between high growth and value, and the market hates tweeners. Traders on the Interactive Brokers trading platform are watching the options chain, and the puts are extremely active, suggesting many are betting on more downside. The risk is that today's Q